All right. Hello, everybody, and welcome to another Batting a Thousand, where we interview the heavy hitters in the mortgage industry. And there is no bigger hitter in the industry, as far as I'm concerned, than my guest today, Barry Habib. Everybody knows him. He's a man that doesn't really need an introduction, but I do want to cover some of the key things that he's done because Barry has been such a legend in our industry, such a dear friend to me for so many years and colleague. He is the only guest that I've had for 4 straight years on Betting a Thousand. I'm so grateful every year he provides his time for us to sit down together. And I can't think of anybody that I would rather have every single year to come on because Barry brings so much value when he comes. Barry is an Amazon #1 best-selling author, as you well know. Money in the Streets. If you don't have it, you better get it. It's a great book. He also just recently again won the 2024 Crystal Ball Award. That is the fourth time out of the last 7 years. That is an unbelievable accomplishment. He is widely credited with saving the mortgage industry in 2020 from margin calls due to the Fed actions that were happening at the time. He has done so many things to help so many people, and he was just named as one of the board of director on the Fannie Mae board, which is an amazing thing. Barry, uh, it is so great to be with you, my dear friend, and I'm just honored to call you friend and colleague.
Dale, what can I say? You know how I feel about you. I just think that you're one of the most important people in our industry, and you are one of my closest friends. I'm so proud to be on with you, and give Jake a shout out, who's in the background there. But Jake Vermillion, who is just Dale. I have to tell you, I'm watching him on things like LinkedIn and social media. He's such a stud. So
We can't keep up with him.
no, I get it. I get that.
That's so good. Well, I love you, my friend, and glad you're here. So we got a lot to talk about. Let's start with this appointment of the board. Tell us about that. I mean, what an incredible accomplishment. And man, I'm so glad you're there because we need your voice on that board. How do you think your presence on that board is going to help shape that board and help shape policy and things that we're going to see in the industry in the coming years?
Well, you know, admittedly, I'm brandy new and I don't have any experience as to how influential a board member can be or not.
Right.
I'm kind of just feeling my way. I was on a couple of the initial meetings, and you get a chance to vote on a couple of things, which is kind of cool. There's 9 board members. They're
Yep.
all really, really nice. They're all really,
Yep.
really smart.
Yep.
But to be and the CEO is really great. So to be in this position where it's one of the 50 biggest companies in the United States, to
It's
be
amazing.
a board member, I'm humbled by it. And what I of
Yep.
course want to try and do is just bring the voice of the origination community in any way I can. Again, I don't know how influential that's going to be, but I think I have, just like you do, a reasonable finger on the pulse of things that originators um,
Yep.
and consumers can benefit from. So if
Yep.
there's any way that I could do that, I will. Again, I don't know how influential that will be, but I promise I will be doing the best I can.
Well, it's interesting because the reason I phrased that question that way is because you stated it a moment ago. The knowledge you have of the consumer side, I think, is going to be incredibly helpful to the board. There is so many incredibly brilliant and well-known people on that board that serve in the industry that have served for years and done incredible things. I think you bring a new perspective, though, with your understanding of the markets, the way that interest rates work, the way that the Fed works and just how consumers react to that. I think that the fact that you came out of the front line just like I did years and years and years ago, decades ago, really sets you up to bring a unique set of circumstances in that. I'm really excited to see you on there and see what's going to happen with that in the coming
Thanks,
months and
thanks,
years. It's going to be
thanks,
fun.
Dale. Thanks,
So
my
let's talk
man.
about the market. What tell us what's happening. I mean, I got Barry Habib on, man. The first thing I want to know is Barry, what's happening with rates, what's happening with the market, what's happening with housing, and what do you see? What do you see in that crystal ball award that you keep winning?
So home price appreciation slowing, sales dismal, but we're around that 4 million level annualized. We've
Yep.
been there for a while, so it's been kind of not wonderful for a while. We really should be closer to 5 million units.
Yep.
The key is going to be where rates go, because I believe there's a lot of pent up demand. You know, Dale, the amount of building that's gone on has really slowed. I think it's like 1.275 million homes annualized right now.
Yep.
But the demand side is household formations. And they've been running historically about 1.8 million. But you know what? With questions about the economy, with interest rates being high, with affordability being at challenging levels, that's dropped to about 1.1 million households being
Okay.
formed right now. But it's not going to mean that that stays like that forever. You're going to revert back to the mean. What's happening now is people just taking longer. They're waiting a little bit longer to make that move. But
Yep.
life events are going to happen. They're going to have the child. They're going to want the backyard. They're going to want the home office. They're going to want, you know, whatever it is. So we will see that catch up. But the key is going to be we need to see some lower rates. You know, Dale, today we heard from Case Schiller and FHFA on appreciation, and if you take the seasonally adjusted number, it showed that it was down month over month 0.2%. But here's the thing: is that on a non-seasonal adjusted basis, which means the actual number, it was up 0.4%. So home values are still going up. It's just that when they
Crazy.
seasonally adjust it, the headlines look as if it's worse. Now that said, you know, I wouldn't be surprised to see this continue to slow down unless we get some relief in interest rates, because it has been a tough go for us. And you know, I think what we've learned from some of these periods of time when we've seen rates come down a little bit, and there's been 7 such occasions in the last 2 years. Unfortunately, as you know, they've been very brief. But what
Right.
we've learned is, you know, yeah, we don't need 3% or 4% or 5%. Man, we get like in that 6.25-ish range.
Yep.
And I think that we start to see a lot of refis, and I think we start to see purchases really pick up in a meaningful way. Now, you know, Scott Bessent, he told me that he thinks 3.9% is the target. I think that's great if we can get there on the 10-year.
Yeah.
That would translate to about that 6.25-ish range for mortgage rates on a 30-year
Yep.
fixed. So I think that does the trick, Dale. I mean, what do you think?
Well, I agree. It's interesting. I've I've shared this with so many of my clients over the last year. You know, I've never seen before the time we're in now, where in this industry, literally rates change an eighth, a quarter in a day, and activity spikes. Like consumers are seeing the numbers in real time, they respond in real time. And you said something great a moment ago that I want to key in on that I agree with wholeheartedly. Is still hearing loan originators saying, "Oh, we need to get down to the fives." No, we do not. There is a new norm that's been established both with consumers and lenders alike. Borrowers understand we're in for the long haul now on these interest rates. It's not going to go back to three like it did in 2021 or two and a half. It's not going to happen anytime soon. So they're looking for that little bit of break that says, yeah, this might be the right time. And the fact is, even in today's rates, if we're at 6.5, 6.75, there's tons of opportunity out there. We talk about that all the time, you and I both, as we teach loan officers and leaders across the nation. But there is no question. If we get in the low sixes, if we hit the high fives, it's almost going to feel like a refi craze has come back, because that's going to create a lot of activity in the consumer markets for sure.
At 6.25, the estimates are for 4 million transactions to be in the money to refinance at 6.25. To put it in perspective, in the entire year of 2024, there were only 1.3 million refinances done. So
Wow.
that would be a big upswing. Now, there is something going on that very few people are aware of, and not a lot of people are talking about. But let's bring this up to everyone together. So
Okay.
Scott Bessent has been talking about a bank deregulation deal, and it's really one of his pet peeves, and he really wants to
Yep.
put this together. So what does that mean? As you know, Dale, banks, the way they make their money is they borrow it from us, you know, and pay us a small amount, and then they either invest it or loan it out at a higher rate. So the spread is what they make, and that's the profitability.
Yep.
So it's a pretty good gig. And you would think that, man, I should take in as much capital as I can, much cash as I can, that I could borrow from depositors and loan out or invest as much as I can at a higher yield. And that gives me, you know, a lot of profitability, right?
Yeah.
Well, there's a limit on that. And
Right.
the limit on that is typically you have to keep an amount in reserve of your own capital, the bank's own capital. If they're a
Right.
big bank, about 5%. If they're a smaller bank, around 6%, so that if some of the investments or loans go bad, the depositors are protected. So
Right.
that's the way it works. So that limits you. Now listen to this, because Scott Bessent, what he's saying is, okay, well, that applies right now if you invest in treasuries. But he says treasuries are a risk-free asset. It's backed by the full faith and credit of the U.S. government. So
Yep.
why would a bank investing in treasuries now be limited in having to hold reserves of 5% or 6% of that instead of putting that capital to work, which really makes it a lot easier for banks to do that. Now, 3 weeks ago, under the radar, both the FDIC and the Federal Reserve put forth a proposal to move this forward.
Hmm.
So I think that was a big step. And again, nobody's talking about this because so few people really understand what's going on here. But if this does pass, in the words of Scott Bessent, he says it is worth in yield on the long end in mortgage rates tens of basis points. So literally that means at least
Wow.
20 basis points drop. But I've asked some really, people in the know, and they seem to think it could be somewhere in their neighborhood of 40 to 70 basis points
Wow.
improvement in long-term rates.
Wow.
Now, that would be a wonderful welcome for us, especially as we've discussed that these things could result in a refinance boom and getting buyers off the fence. I mean, getting
Yep.
back in action and getting people with that pent up demand to move forward.
Yep. The beauty of that is the activity that would create would certainly create a lot of opportunities in the marketplace. And that would make the long term outcome and outlook of the mortgage industry in the next several years much, much stronger coming in this. But let's talk about where we're at today, because that would be an ideal scenario and situation. We'd love to see that happen. But with where we're at today in rates, you and I, we every day are out there teaching people how to be successful within the market that they're dealing with today. Let's talk a little bit about some of the opportunities that we see out there today. I know for me, as I'm talking with lenders and loan originators all over the country, the thing I keep going back to as the number one indicator of opportunity for loan officers is debt leverage. It's looking at the consumer debt and the massive numbers we've seen. We have seen consumer debt, credit card debt specifically, has increased 55% in the last 3 years. It went from 750 billion to 1.12 trillion in that 3 year period. It has just skyrocketed in the last 12 months. You combine that with student loan debt that's back in play. You combine that with auto loan debt that's huge, and the rates are high on it. You combine that with home equity debt. All of a sudden, you're looking at a picture where both on purchase and refi, this applies to both. On the purchase side, it applies in that a lot of times where people are looking to try to create affordability to buy a home, they're worried about, geez, how much do I have to put down to qualify? Well, sometimes it's not putting more money down; it's paying off more of the debt with the money you have. That's going to create better affordability. But on the refi side, even at 6.5% rates on mortgages, when you're dealing with somebody with a 3.5, or 4% rate on their current mortgage, if they're loaded in debt, which a lot of people are, you've got a lot to leverage in payment and term reduction that you can literally change your life. And I know MBS Highway, you guys have built tools that support this. Talk a little bit about that, because this is something you have been instrumental in driving for decades in the mortgage industry.
Well, we do have some tools that make it really easy. But Dale, you've been teaching this forever. In fact, you coined the term, code cash out debt eradication, right? So that's
Yep.
you get credit for that. That you coined that phrase and that acronym, and you also have really been teaching this very successfully for many years through different markets. So yeah, the tough part we've had for the last 3 years is rates, but the good thing has been appreciation. So
Yep.
you have a little bit of amortization, you got good appreciation, that
Yep.
creates equity, and there's a lot of magic that can be done there.
Yep.
There are so many ways for us to expand our horizons. For example, Dale, you know, 1 out of every 6 transactions is an investment property. 1 out of 6. That's a lot.
Wow. Wow.
So most people kind of just dismiss that entire marketplace. But here's a way to really get your foot in the door. In the One Big Beautiful Bill Act, what happened in there was that they allowed permanently for a cost segregation structure. Let me explain what that is. So One of the nice things about buying an investment residential property is you get depreciation. Thing is, though, is that depreciation is over 27 and a half years. So look, if you've got if you got a $500,000 property, you divide that by 27 and a half years. I don't know exactly what the number comes out to, $13,000 or something like that, and then
Yep.
that's your deduction. It's a nice deduction, and if you're in the 30 something percent tax bracket individually, and then maybe you're in a state that has state income tax too. But if the number is roughly 40%, your total tax bracket that you're in, you get a nice savings, about $7,000. But listen to this. If you do a cost segregation structure on it, what the government allows you to do is say, you know what, only the brick and mortar should be depreciated over 27 and a half years. The other items, which amount to approximately 40% of the purchase price, can be depreciated in year one.
Wow.
So let's look at the same example. Same exact example. $500,000 home, 40% of it is $200,000. $200,000, that's a tax reduction I get. That is a income reduction I get. So I get to offset my income by $200,000. If I'm in the 40% combined federal and state tax bracket, that's $80,000 cash. If you're buying a home for $500,000, you're going to put 20% down, you're going to get $80,000 right back. So for your
Wow.
clients, for your realtors that are looking for something. Now, by the way, what about the other 60%? Because remember, we took 40% cost segregation structure, right? So the other 60%, you still get the 27 and a half year depreciation. So that'll put another $5,000 in your pocket. So if you buy a home for for $500,000, you put $100,000 down, you're going to get $85,000 back in year one. And now you have an
Wow.
appreciating asset. Who knows? Maybe it's going to cash flow positive for you. But this is a really, really good tool. I think it needs to be explained to real estate agents. It needs to be explained to buyers. Now, you do need a certificate of this. I can help with that. Dale, I could send you the info on how people can, and I'll send it to you and Jake, if they wanted to get how they go about getting a certificate for this.
It's
But it's
amazing.
very easy to do. They have to pay for it a little bit, so the buyer has to pay like $1,000 to $1,500 to get that certification on how to do it.
Some
But
change, right?
right, but considering what this does, it's a really, really good thing for you to be able to do. I'm just trying to say, let's think out of the box a little bit, right?
That's,
One
that's
more
awesome.
that kind of thinks out of the box, Dale, is you see builders, they put something out there, and I hear originators complain, say, well, that builder's at 5.99, how can I compete with that? I'm at 7%. Well, you know what? You could do the same thing. And what we're teaching loan officers is to get with their realtor, and the realtor gets with the seller and says, look, you got that $500,000 home. You probably got a little flexibility in the price anyway. So instead of just putting it out there saying $500,000, put it out there, and then how much does it cost to buy the rate down to 5.99? Now, it'll change daily, of course, and depending on where rates are. But as of today, Dale, I kind of did the math on it. It's about 3.8 points to get a 5.99 30-year fixed. So
Okay.
3.8 points on the loan amount is about equivalent to 3% of the sell price. So
Okay.
instead of saying, hey, I'm going to sell my home for 500,000, and maybe I got some flexibility out there and mortgage rates are market, I'll stay pretty firm on the 500 because you're going to get 5.99, and I bet you get more traction. And the people that we've mentioned this to and taught this to are seeing really good results, and it gives you another reason to get with that realtor and brainstorm with them.
It's awesome. It's awesome. I love well, both of those strategies are incredible. Thanks for sharing those. Those will be very helpful to everybody watching this. And the investor thing, I know that's something that, as I've been training around the country, talking to retail loan officers, like they're all chasing the realtors. The investors are such a huge opportunity because not only are they people that once you get them, they're going to repeat buy from you again and again and again. But you got to remember, they're both the customer and the referral network at the same time. It's a double dip. They become a customer for you that is very loyal. When you do an investor loan right, they'll just come back to you. They don't even ask questions. They're just like, I need another house. I need the money fast. Here's what I need to get my application approved. So you get a lot of repeat business out of them, but they know other investors. Investors hang with investors. they know who you can be talking to, so you can build both sides of the equation when you do that. And I see too many loan officers, they're chasing the same old realtors they've been chasing for the last 5, 10 years, and they're not expanding out into investors, into small lenders who don't do mortgage loans that they can be working with, into financial planners, wealth managers, divorce attorneys, all these other resources that are out there that create a wealth of opportunity.
All the
I
ones you,
believe
all the ones you and I solicited when we were doing loans.
that's exactly right. You know, there's more referral opportunities out there we can get to in a lifetime if we just open our eyes and put our head on a swivel. I truly believe that.
Yeah.
So,
And Dale, one of the keys is interest rates, and a hot topic is the Fed.
yep.
And Jerome Powell's come under a lot of criticism. Look, I've been very public in my criticism of Jerome Powell and the Fed since late 2021, where I felt
Yeah,
that
deservedly
they
so.
should they should have been hiking rates. I know it's like
Yep.
it almost seems like heresy. Why would you be rooting for hiking rates? I wanted them to stop QE, and I wanted them to start increasing interest rates modestly, because you didn't have to be a rocket scientist to see all the inflation that was coming. But
Yep.
unfortunately, the Fed didn't. And up until the March, April 2022, they kept interest rates at zero, and they also kept quantitative easing going. So
Yep.
this really, they were very complicit in creating the inflation and creating, as a result of that inflation, the higher interest rates that we've been subject to. And of course,
Yep.
not to mention people that struggle buying stuff at the supermarket. Okay, so
Yep.
it's been painful, and I think the Fed is very much complicit in what has occurred there. So now it seems to me that they're making the same mistake again. So the Fed has been very backward looking, almost like driving a car, but while looking in the rearview mirror, because they've been saying always, oh, we're data dependent, we're data dependent. And they always say, we know that Fed actions have long and variable lags. So they acknowledge it takes a long time for Fed actions to sift their way through. So that's why you have these boom and bust cycles. They're always too late. That said, right now, what we are seeing, what our numbers show, is that the labor market is not as strong as Jerome Powell seems to think. We also think that inflation is relatively well behaved, and we think Fed rate cuts are warranted. In fact, Dale, we are hearing almost like a mutiny, members of the Fed calling out Jerome Powell and
Yep.
saying, and you've never seen this. By the way, if you get two Fed members that will dissent, two governors, be the first time that's happened in 32 years. 32
Wow.
years. Yeah.
Wow.
And the first time if two voting members, you got presidents and governors, if two voting, that'd be the first time that it happened in 5 years. So they tend to fall in line like lemmings. But now I think that they have come a little bit to like wake up and see that they don't want to get behind this and put the economy in a tough position. And they really look, the way that you look at the Fed and their positions is you could be either accommodative, we want to spark the economy, we want things to grow. Restrictive, we
Yep.
intentionally want to slow things down, or neutral. That's kind of like Goldilocks. Okay, so how do you know where you are? Well, you take the rate of inflation as measured by core PCE. As we speak, that's 2.7%. Then you add something called R star to it. I know it's a crazy freaking, I don't make this stuff up. They do. R star, right? So you add R star to it, which is about 0.75%, and you are roughly at around a neutral rate of in the range of 3.4% for the Fed funds rate. But where is the Fed funds rate right now? 4.375. So one almost, but rounding it, almost 1 full% restrictive. So that means the Fed is kind of like got its foot on the neck of the economy and intentionally trying to slow it down. Now, I don't think that that's wise. I think that the Fed should be cutting here. I think they should have cut at the July meeting. I think that September they definitely should cut. And I
Yep.
wouldn't be surprised to see if we get more. But Dale, what this does is it raises the question, okay, Barry, hold on a second. Let's go back to September 18th of 2024, and then November 7th of 2024, and December 18th of 2024, where you saw 50 basis points, 25 basis points, and 25 basis point cuts, but yet mortgage rates did not respond. In fact, maybe they went up a little bit.
Yeah.
What went wrong? If you take a look at a slightly longer term horizon leading up to the September 18th cut, mortgage rates dropped by almost 1%. So leading into that cut, mortgage rates were declining rather
Yeah,
significantly.
they were.
But there were things that happened right afterwards. After each of those cuts, we had the BLS come out with enormous job gains, each of the three times of well over 200,000 jobs. That scared the bond market.
Yeah,
Now, what do we know about that, Dale? They were revised lower, of course. We know that. Even Governor Waller saying, we know that the numbers from the BLS are unreliable. We know that we anticipate them now to be revised lower. Think about that from a Fed governor, right? So so that's what happened. And then in
oh,
January and February, if you look at the inflation monthly readings for the last 13 months, those were the only 2 months that saw inflation get a little bit higher on a monthly basis. Things like prescription drugs were a little bit out of whack, medical insurance, things of that nature caused this kind of 2 month spike. So when people say, well, what if the Fed cuts? So what? Mortgage rates didn't respond last time. There's one other thing I want to tell you, and then let's look longer term. And the other thing to talk about is that before, when you looked at the Fed funds rate and you compared it to available money market rates, well, the Fed funds rate was at a point where even if you were bringing the Fed funds rate down, there were other instruments after 100 basis points cuts by the Fed that were paying you a pretty good return. So you didn't have to move your money and put it into treasuries yet. But now,
right.
if we came down another 100 basis points, well, now you'd be able to make arbitrage and invest in treasuries. Okay, last point on this. If you take a longer term view, I'm going to go back into the 1960s, Dale. And if you looked at it, if you like, I'll send
My
Jake,
generation, your
yeah,
generation.
both of us. I'm going to send you and Jake the charts on this so you could see it. But you can see clearly that there is a very strong correlation between the Fed funds rate and the 10-year Treasury and mortgage rates. As the Fed funds rate rises, it brings the 10-year and mortgage rates up. As it
Yeah,
declines, it brings them down. And you could see it's very clear. Now, yes, it was a bit of an anomaly that we saw in the fall of 2024. But I think that there is, look, other things can happen, Dale. Nothing's guaranteed, right? So
right.
I think that if the Fed starts cutting, we should see some good things happen to mortgage rates.
Yeah. Well, here's my vote. I'm voting you as the Fed chair. We got
Oh
you on
my
the Fannie
God.
Mae board. Let's get you as the Fed chair, Barry, because I like the way you're
Well,
thinking.
Dale, that's so kind of you. But there are some really good candidates. There are a couple of things as we start to think about Jerome Powell's term ending in May. Now, I don't know if he'll be 100% to make it. I hope he does. I hope it doesn't disrupt things to where he gets terminated. It's going to be May, for goodness sakes. It's
Yeah.
close enough. So Governor Kugler's seat expires in February. Watch for the replacement for Kugler's seat because that will likely be the next Fed chair. Who are the good
Okay.
candidates? You've got Governor Chris Waller. He's really smart, and he is someone that would be very good for our industry. You've got Kevin Warsh, also another person, unbelievably smart, was a great Fed governor from 2006 to 2011 or so. The
Okay.
guy's a stud. So there's two great candidates there. There's Kevin Hassett, who is another really good candidate. And then dark horse might be Michelle Bowman, but she was just put in charge of a banking committee. So I think that she's probably good for now where she is. But I believe that if one of those three candidates were to become the next Fed chair, I think that these individuals are really sharp and understand it. Remember, Jerome Powell is an attorney, not a trained economist.
Yep. Exactly right. Well, that's encouraging as we think through the forward side of the industry and where we're headed. Closing thoughts from you on today. What would you recommend? What would you be giving people as the number one recommendation to succeed today in this market? Okay, let's put the market aside. What's going to happen? You've given us such a good picture of that, like you always do. And I so appreciate your knowledge and your wisdom and just the way you interpret the numbers. And you've got that it factor nobody else has where you just see this stuff. I mean, you were made for this kind of a role for the everyday originator, the everyday lender out there, what would be the two or three things you'd say this is what you got to be doing right now to capitalize on this market?
Well, Dale, I think that we know something that's very important in every relationship. And whether it's a mortgage applicant, that mortgage applicant and the loan officer, whether it's the loan officer and their colleagues, whether it's one of us with our family, one of us with person we love, right?
Yep.
What's really important is trust, and
Amen.
I think that trust makes everything just so much better. You
Yeah.
know, goodness, Dale, all these passwords we got to remember and change, and even things like going through airport security, what a hassle. That's all because trust, right?
Yep.
So, not having trust causes a lot of slowdown. And if we are able to establish trust with our client, it makes things so much better. Now, there's a limited time that you have because if you're going to be speaking to that customer and you're going to have just a few minutes to talk
Yep.
with them, and a lot of people like the emails, but it's important to have at least a dialogue, a conversation. Let them get to know you. Let them hear
Yep.
your voice. Let them hear your excitement and your wisdom. So the way that you could build trust, I think there's two very important ways. One is vulnerability. Now, Dale, you and I could do a whole talk. I know you're quite an expert on this as well, where you and I could talk about how important vulnerability is. But for purposes of today, the other is with knowledge. And we have to understand, especially with AI, we don't want to just be in the information business. You don't expect to pay for information, but you pay for
Yep.
wisdom and knowledge. So how do we do that? How do we do that in the first 5, 8, 10 minutes that we're on the phone with the customer? So Dale, when we all can relate to having been tested, whether it was in school or whatever, if we knew the questions in advance, chances are we'd score better because we can prepare better, right?
Yep.
And what's amazing is that we know the questions that the client's going to ask us for the most part, right? You know what's coming. It's
Yep.
Dale. Tell me, is this a good time to buy? I'm a little worried. I'm hearing this stuff. What happens if we got a
Yeah.
recession? What happens if we're in a position where home values start going? I just saw the headline today; they were down 0.2%. I heard Diana Olick saying there's going to be a crash. What happens if there's a recession? The home prices crash. And then and by the way, which way are rates heading, and what does that mean for me? Now we know that that's coming. We know that that's definitely coming 100% of the time.
I couldn't agree more.
Okay, so how does a typical mortgage originator answer that very important question or a
Yep.
series of questions? It's something like, well, the market seems pretty good right now. And boy, interest rates, if I knew where they were headed, boy, I'd be retired or having a pina colada on the beach. Ha ha ha. Now, did that do anything to establish trust? But you really had a
Nope.
chance. You really had a chance to knock it out of the park. So know your current market, know the inventory situation, know the statistics, know what previous appreciation is, know household formations, know what the building is, know that for the last 83 years, home values have gone up 77 out of 83 years. So it's probably one of the most consistently well-performing assets, and it was all in one period where underwriting guidelines were, you're looking at no income, no asset, no job, 580 FICO score, investment property, zero down payment. It was a crazy time.
Yep.
So overall, the real estate market has been very, very secure. Now, as far as rates, think about all the things we talked about. Just reiterate some of those things that we just talked about today, and then you're going to sound very different from your competitors, and hopefully you increase the level of trust between you and that client. What you really want that client to do is compare you to the pina colada guy and say, wow, I'm learning something here. What else am I going to miss if I don't do business with you?
Yeah. It's good. I love that. It never ceases to amaze me. And we've been such good friends for so many decades now. And you are just my favorite guy in the industry, no questions asked. Like,
I feel the
we
same
talk
about you. I feel the
we talk
same
all the
about you.
time. So you know the love here. It's funny how I find we're so in the same plane of thinking about things because just month before last, my entire focus for the month of June was trust. That was the topic. And I reminded people of something that I think is important. If you look at the definition of trust, here's what it's defined as: assured reliance. Think about those two words: assured reliance on the character, ability, strength, or truth of someone or something. Now, here's what I've said to loan originators. I said, when I talk to people about trust, I always hear this from them. Well, I'm a very honest, high integrity person. I'm trustworthy. And my response is you can be trustworthy and not be trusted. You need to understand that. It's not just your integrity. That's one part of trust. It's your ability, it's your knowledge, it's your skill level, it's your character, it's all of those things. So when you talk about trust, I could not, I love that you closed with that because I don't think there's anything more important. And you're not going to build trust through sending somebody an online link. You're not going to build trust when you can't pick up the phone and call your customers. You're not going to build trust when you have a borrower you made a loan to 3 years ago and you haven't talked to him since. Like you haven't earned the right to the business when you don't do that. Trust is based on relationship and it's built through connection, communication, and conversation. Those are the three things that happen.
Dale, you said something so beautiful. You could be trustworthy and not trusted because, as you have so beautifully put, you haven't earned it. But there is chances to gain some more trust. There's chances to
There is.
where you could prove that knowledge. So make sure you're taking advantage of that, and just be on top. Be a master of your craft.
That's right.
Just be you get paid and compensated very, very well. You know, don't do the things that AI can do. Don't do the things that your phone can do, and
Right.
expect that that's going to entitle you to be paid at a very, very high level. Earn that by being head and shoulders above your competition and really understanding market conditions and forces and advising your clients so that they say, wow, man, this is someone that really is on top of their game.
Yeah. And the best way to do that, if you are not subscribed to MBS Highway, do it today. That is where you're going to get that knowledge from. That's where you're going to get that base level from. So you can become the veteran. You can become the expert, the master class person that can really teach people what's happening in the market. You can speak with authority because you're learning it from the best in the business. That would be my advice. How do they connect with you and contact you over at MBS Highway, Barry?
Social media. I mean, my email is barry@barryhabib.com. It's
Yep,
very easy. Social media, I'm all over. I am Barry Habib. If you want to follow me on Instagram or LinkedIn or Facebook is easy too. So I'm pretty easy to find.
you are. So let me close with this. You've gone through a couple of tough years. Last time you were on the show with me last year, you were just going through the thick of it. You look like the Italian stallion again, like I said before. You look like a 25-year-old Barry Habib again, all over the place, and it's great to see you with the hair back and you're feeling good. But I know that even though externally you look great, I know you've gone through a lot. We talk a lot. We pray together a lot. We spend a lot of time together on the phone, and we're going to be spending some time together one on one here in the next couple of months. Give everybody an update because, Barry, I want you to know this. My clients, everywhere I go, everywhere I go, ask about you. How's Barry doing? They know we have a long time relationship. They know that we talk a lot, and they're like, how's Barry doing? You have been, gosh, I'm trying to say this without losing it. You have been such a great example of going through something difficult and yet having so much integrity, so much humility, so much kindness and positivity. It just blows me away every time I'm around you. I get inspired every time I'm around you, my friend. So
Oh man.
tell us how you're doing and tell us how do you maintain that persona when you've gone through such difficult things.
So I'll try and be quick. So my cancer is it's not a good cancer to have. It's a
Yeah,
double hit B cell lymphoma, and there's a mutation within the cancer called the P53 mutation, which makes it very resistant.
yeah,
I did the most rigorous chemo that there is. It's called EPOCH R. It was absolutely brutal, and
yeah,
that did not do the job. I got a partial response, not a complete response. So then we said we're going to do CAR T. They take your cells and they program, they put them back. So to prep for that, I did some radiation, did some more chemo, did the CAR T, and got it to where there was a good improvement, but then it kind of relapsed just a month and a
yeah,
half, 2 months later. So now they have me on this thing, glofitamab, and they have me on this oral drug too, lenalidomide. So I go, I get, I've got the support here, and I go every 3 weeks at MSK, and I sit there for a couple hours. I get an infusion. It's not too bad, it's not like the chemo was. But then, through the grace of God, I was able to find Dr. Patrick Soon-Shiong and Dr. Sender in LA. They have
yeah,
a drug called Anktiva. I'm patient one in the world. that has been able to to receive this. It's approved for bladder cancer. It's not approved for my type of cancer. But what it does is it gets your T cells and your NK, natural killer cells, to be a little stronger to try and fight the cancer. Well, after starting this, my first scan afterwards was the best scan I've ever had. It's in remission. But this type of cancer tends to come back. I've been very blessed. There's a Dr. Alisi at the Karolinska Institute, which I was put in touch with in Sweden. And he said, look, Barry, I'm going to be very honest with you. He said, this is really a marathon and not a sprint. He said,
Yep.
the type of cancer you have, it tends to come back. So it's something that you try to manage as opposed to, look, we pray to God maybe there is a miraculous cure, but we want the remission periods to be as durable as possible. So I'm going to continue, even though we're in remission, I'm going to continue with these treatments through December, early December. So every 3 weeks I fly to LA. Every 3 weeks I go to MSK. So there's a lot of back and forth. But look, it is what it is. I feel pretty good. Not
Good.
100%, but I feel pretty
Yep.
good. And to answer your question, to get through this, I hope I've done a good job in getting through this, and
Oh, you have.
it's gratitude. It's gratitude. I pray every morning. I pray for you every morning. I pray every morning, but I literally thank God for this dream life, and I thank God for all of the amazing things that I have in my life. And even though I have this, I thank God for this incredible life that I have been able to experience. And that's what helps me to get through, is because while I have this, boy, I've got so much good. I try and focus on that and being grateful, and and that's what I think really, really, really helps me. And you don't have to have cancer for that, heaven forbid.
Yep.
Whatever issue you're going through, we all are. Every one of
Yep.
you is.
Yep.
Every one of you is. Start each day with gratitude. Focus on the gratitude, and it will help you get through some of the more difficult periods of time. I promise.
Well, Barry, you've been an absolute inspiration to the entire industry, and we're so grateful for you. And I know that sentiment is true for millions, not just me. And you're right. Sit down, make a list of everything you're grateful for, and just dwell on that. And we will continue to pray for you. And hey, God is big. He is good. He can do anything. And we're praying every day here at We're Champions for just a miraculous recovery, that you're just going to show up one day and they're going to go, geez, Barry, we don't know what happened, but there ain't no cancer and it ain't coming back, because I am certain you're here for a lot of decades yet, man. We need you around. You are the leader in our industry. You're the guy who shows us which way to go, and we appreciate everything you do. And nobody would have known you're sitting here with COVID a couple days ago, and you're here, and nobody would have known except for me, because you told me. So thank you for gutting this thing out. Again, we would have gladly rescheduled, but you wouldn't have it because you're Barry Habib, and you gutted it out like you always do. Love you, my friend, dearly. You mean the world to me. So grateful for you, and so grateful for what God has done in your life and going to continue to do in your life. So
God bless you, Dale. You're a
can't wait to
gift.
see you.
You're truly a gift. Love you. Thank you.
You too, my friend. Well, this has been another Batting 1,000, where we talk to the heavy hitters in the industry. My favorite guest of all time, always, Barry Habib, been with us today. I know you've learned a ton, and I know it's been a blessing to you, and it has been to me. We'll see you on the next one.